Chapter 11. This is Part 5, PP&E and Goodwill impairment under GAAP and the International Standard. So, for assets to be held and used, different guidelines are applied. For property, plant, and equipment and intangible assets with a finite useful life, they're subject to depreciation, that's for equipment, depletion for natural resources, and amortization for intangible assets such as patents or trademarks. Intangible assets with indefinite lives are not subject to amortization, but may be subject to impairment. Now, determine asset impairment under GAAP. We have the recoverability test. Determine if the undiscounted expected future net cash flows are less than the carrying amount. If no, then there's no impairment. If yes, then we have to go to test 2. Test 2, we compare the fair market value to the carrying value to determine impairment loss. Assets held for usage determine new depreciation rate but cannot restore impairment. Assets held for sale, no depreciation is taken and can restore impairment loss up to the net book value at the time of the write-down. So let's take a look at an example. All right, we have a piece of equipment that we paid $10 million for with an estimated useful life of 8 years, no salvage value. And then after 2 years, new technology is introduced, and we're saying the future net cash flows of the equipment are $6.3 million and that the fair value of the equipment is $5.6. And they tend to use the equipment, but they're saying the remaining life is only 4 years, and they use straight line. So we need this information. We want to write that down because this is how we're going to determine if we have an impairment. So first, we're going to compare the net book value to the future cash flows. Here's our cost minus depreciation for 2 years has a net book value of $7.5 million, which is greater than the future cash flows, so there may be an impairment. Now we do the impairment test. We compare the net book value to the fair value, and it says we're going to have a loss of $1.9 million because on our books, the equipment should show as $5.6 million. So here's what we're going to do. We're going to adjust our equipment and accumulated depreciation accounts. We're going to write down the asset to the fair value, and we're going to remove the accumulated depreciation. And this is what it will look like after our journals. Now, here's our journals. We're going to do impairment loss. We're going to take the accumulated depreciation off the books and take the net difference from the equipment account. Now we're going to record our depreciation expense in 2027. Now, the fair value of the equipment at December 31st, 2027 is estimated at $7.9 million. Since we have used the equipment, GAAP does not allow you to write it up. So now what happens? So now we have our December 2027 fair market value adjustment. Net book value cannot exceed the net book value at the time of the write-down, so you can write up to $7.5 million based on the fact we haven't used it. So we're able to recover the $1.9 million. That's the maximum we can recover. Now, what does it look like under the international standard? Well, we have a net book value of 7.5. We have undiscounted cash flows of 6.3. We have net book value of future cash flows of 6.1, and we have a fair value less cost to sell of 5.6. We have to determine an international standard, is there an impairment? So we're going to take the net book value and take the lesser less the higher of the net present value versus the future value, which is 6.1, and we're going to have an impairment loss of 1.4 million. Now, if the asset value increases, you are able to write up even if it's been depreciated under the international standard. Now let's take a look at goodwill. Goodwill, it is a unique intangible asset. Unlike other assets, its cost can't be directly associated with any specific identifiable asset, and it is not separable from the company as a whole. So goodwill is what's left over between the difference of what you paid for something and what the fair market value is of what you received. Impairment of goodwill can't be measured in the same way as other long-lived assets. Level testing is the reporting unit. A reporting unit is an operating segment of a company or a component of an operating segment which discrete financial information is available. And normally management would receive reports on it. Now, goodwill impairment under GAAP, tested annually and more frequently if events or changes in circumstances indicate it's more likely than not that the asset's impaired. Normally people do it annually. The test, if the book value exceeds fair value, an impairment loss is recognized for the difference. There is no recoverability test. If an impairment loss is recognized, the write-down book value becomes the new cost base for future cost allocation. So let's take a look at an example. We have a company paid $550 million for a company that included assets with a fair value of $550 and liabilities of $100 million, which means it had a net book value of $450 minus the $550 means you had goodwill of $100 million. The end of 2025, the following information was provided to determine if an impairment loss should be recorded. So if the fair value is the same as the selling price less costs and the present value of the future cash flows is $360, first we determine the goodwill. Again, we take the $550, which is the fair value. What did you pay for it versus the net book value? Based on its fair value, says we've got $100 million as goodwill. Now, a goodwill impairment loss is indicated when the fair value of the reporting unit is less than its book value. So, the fair value is less than the book value, so we have an impairment. So now we're going to determine the impairment, which is going to be the book value, including goodwill, versus the fair value of the net assets, including goodwill, which means we have impairment of $25 million. So we're going to do loss on impairment, $25 million, goodwill, $25 million. Now our goodwill is valued at $75 million. Now, what does it look like under the international standard? Under IFRS, the impairment loss is the difference between the book value and the recoverability amount of the cash generating unit. Recoverability amount equals the higher of the fair value less cost to sell and present value of future cash flows. So, the book value including goodwill is $380, and we're going to pick the higher of the net book present value versus the present value less selling expenses, and that tells us that we have a $20 million impairment under the international standard. That concludes this presentation.